For those of you that don't know me, I am Danielle Patterson, CEO of Family Office List, and I am very grateful for our speaker, Brian Franco, who is here today to tell us, all about his company and mergers and acquisitions, and I couldn't be more excited. Thank you for everyone who attends. I know the summer months can be super hard and busy. Our family just returned from 2 weeks, and I'm just unbearing myself from the emails and whatnot that pile up. But I really appreciate everyone's time. I know this is going to be an awesome session. A little bit about Brian. Well, he and I actually met through LinkedIn. And for those of you who joined early, I encourage you to drop your LinkedIn URL in the chat. Brian shared his, I shared my own. If you're not connected, please do. We're really active on there. And so that's how I actually came across Brian's work. He shares really valuable content. And I think the initial post that kind of caught my attention was he said something to the extent of like, I collapse time by providing founders and CEOs, insights on how to scale and exit their businesses, and how to leave a legacy, with strategic buyers. And I loved that concept of collapsing time because that's exactly what Family Office List is designed to do as well. Raising capital is tough. It takes, a lot of time to develop lasting relationships and trust. But that idea of having a guide, an expert that can really help, save you from making mistakes and help just collapse time. So that was brilliant, Brian. You caught me there. A little housekeeping for everyone. I know I've enabled the chat, encourage everyone to chat here. I've also, sometimes when it gets really busy and loud in there, it's hard to find the questions. So feel free, Brian and I really want this to be an engaging session. The reason we do it live is so it can be about you. You can ask your specific questions. Brian, is here as an expert to help you. So feel free, use the chat, but drop any questions throughout. And Brian, by all means, has asked me to moderate. So I'll go ahead and I'll look at those and bring them up as they come up. As I mentioned, the session will be recorded and we'll go ahead and send out an email tomorrow with that and include information on how you can get a hold of Brian and learn more about his work. I'm not going to just sit here and read his bio, but just, in case you didn't take the time with the Zoom invite, he is the founder and managing partner of Meritage Partners, which is a multifaceted advisory firm. They specialize in mergers and acquisitions and capital advisory and, of course, strategic exit planning. He has over 23 years of experience and he has facilitated transactions worth billions, so definitely an expert here. And he's worked with both private and public companies. And he also has an amazing podcast. It's the Private Capital Mastery Podcast. I felt very honored he hosted me on as a guest last month. Again, just an awesome way to learn, not only from him, but from the people that he brings on and interviews. So without further ado, I really want to make time for Brian and everything he has to share, and hopefully he'll tell us more about his experience, his background in building Meritage Partners. One last thing, again, I appreciate everyone for being here. These sessions are supported by Gift Suite, which is an amazing boutique gifting agency. And so something fun we do to thank our guests, of course, for sharing their wisdom is send them a thank you gift. But we'd also like to thank our amazing attendees. So at the end, I will select someone who's able to, stick through the session with us, and we'll send a Gift Suite prize to you as well. So without further ado, I am going to turn things over to you, Brian.
Fantastic, Danielle. Thanks for having me on. And I see people joining. So if you're just joining, if you're just logging in, welcome to this amazing workshop, MasterClass that Danielle puts on. I see the value in it. And one thing you said, Danielle, is, there's trust that's required in the work that we do and the relationships that we build. Because when you think of capital and capital providers, I've distilled it down. We have, debt capital or we have equity. Right. And you have to find a combination thereof for the particular investment that you're making. But what I find, because where we sit is typically on the capital raising side and the M&A advisory side. But when I think about, okay, well, what are people really investing in? And and yes, there's, there's IP, there's technology, there's SOPs, there's all sorts of reasons to invest in a company.
Mhm.
But before investors underwrite a company or an opportunity, they're first looking at the individuals. And if there's no trust with the individual, it stops.
Yeah.
And time again, it stops. And so having these conversations with other professionals and other individuals in the industry are so crucial because, not only do folks have to trust, investors have to trust those they're investing in, right? It comes down to, you have the business opportunity, or in your family offices are they're also investing in real estate, right? And
Mhm.
so if you don't have the know-how and for a particular real estate investment in a specific geography, you're less likely to succeed. And you may have the trust, you may have the relationships, but if your investors, if you're making an investment into somebody that doesn't believe that they can execute on the strategy, it also stops, right? The conversations typically cease to proceed because you're trying to triangulate the individuals involved. Do you trust them? Yes. Can they execute? Yes or no? And then they look at the opportunity, whether that be a business opportunity or a real estate investment. So I'm really diving in right
Wow.
away, but
No, and I
it's
couldn't agree
just
more. It's like people invest with people, and it's this basic
correct.
principle. A lot of times we overcomplicate it and we think, I mean, yes, your track record, that's all very important. Investments do come down to money and dollars, but the people, it's like you buy with your heart first. You make that decision and then you dive into all your due diligence. So I couldn't agree more. And, any sort of relationship starts with trust. So you nailed it.
Yeah, exactly. Well, I'll back up a little bit, and so you were talking about our firm, and so I'll,
Yeah.
I'll kind of give a quick overview. So this is a couple slides from a recent event I did in Costa Rica. I was speaking to a series of home service companies, U.S. based, and they are looking for strategies, to grow, which requires capital, and others are looking to exit, which requires capital. So we talked about, being exit ready, what have you. But our firm, I founded the firm when I was a kid, and I'll get to that in a second. But 130 years of collective experience. We facilitated over a couple $1 billion of transaction, primarily on sell side advisory as well as growth capital for clients that are looking to grow in a scale. We've been rated by a top investment bank, by Axial Market, several times over the years. We made the top 50 list, the top 25 list, and there's different industry classifications in which we win these trophies, if you would, right?
This is
But
awesome. This is so important, Brian, because it's been a journey. You said you started as a kid, and if we don't stop to reflect on these milestones, these accolades, you kind of forget. So bravo. This is really just tremendous, and to see it all in
thank
one
you.
place. Yeah.
Yeah, thank you so much. And so, well, I'll go in a little bit of my personal background here. If I could get this screen. Oh, this was a completed transaction. So this is just a screenshot of what you could find on our website. These are deals that we've done over the years. If you zero in, the more recent transactions will have video testimonials with myself and the client, sometimes the investors if they're open to it. And then these are obviously transactions that we can publish. There are transactions we cannot publish just because they don't want them published.
Understandable.
And
We
that's
have that.
understandable. I
Yes.
like the stealth wealth approach.
Welcome to
But
the
feel
world of
free to,
family offices.
yes. So here's the shocking, surprising kind of background of Brian Franco. I was a father at age 16. I was a single dad, and it slingshotted me into manhood. That's Jacob in the tie on my far left side of the screen. And I had choices, right? But my choice was always to be responsible and take responsibility for my actions. And so Jacob and I, we've essentially grown up together. We're 16, almost 17 years apart.
I've met Jacob.
And,
He's
and
amazing.
you
I
met
love
Jacob.
that the two of you work together. I mean, and I did.
Yeah.
I wondered about the journey there. So I appreciate that you're sharing your story. I've never heard it. So thank you. Go
Oh,
on.
wow. Okay, good.
Yeah.
Good. And so, at age 17, I became an entrepreneur, and that was, I have my father who's still here on earth. He had a company that was in facility maintenance. He had a massive contract with FedEx, then known as Federal Express. But my father had become disabled through an injury on the job. What was unique about his injury is it was more than one, but it has him in and out of a wheelchair to this day. And I bring this up because I rose to the responsibility to run the family company with, at that time, the CFO. His name was Mong So. Mong So was from Burma, and he would always tell me, Brian, you don't understand the opportunity that you have in America. And he just slammed that into my brain from a young
Wow.
age every time I saw him.
A lot
And
of
so
young kids don't realize that. So what a blessing that you had a mentor
it
kind of like that to help
it
you see
was
the
it
opportunity.
was it was a huge blessing, and I still talk to him from time to time. He's getting older now, but he's an amazing gentleman. But at age 26, I mean, I was still a kid here, 3 months before my wife Melody and I got married, and I started Meritage Partners. And I cut my teeth at a smaller boutique firm ahead of that. And the year I left was 2004, was the last full year. I was 25 at that time, and I was 72% of the firm's revenues at 25 years old.
Oh,
So
wow. They didn't want to
I,
see you go.
yeah, so I left with the vision. That vision was Meritage, and we've been 19 years of the firm, and in about 14 days, we'll celebrate 19 years of marriage,
Oh my
which
goodness,
is amazing.
congrats. I love that it all,
Yeah,
I mean, what a huge game changer for you, to just, hey, if I'm gonna make a change, just let's do it.
exactly. Exactly. And as far as my background in education, I went to school. I thought I was going to be a CPA. I took some law classes. I did this more of a la carte type education process because I didn't have time. I needed to collapse time.
Yeah,
And so, but that's the path and route that I did and I took. But that those experiences and that education has equipped me to be able to transact 21 public deals and probably 3 times as many with private equity groups, family offices, and what have you. I've also acquired companies, I've scaled companies, I've sold companies. So
wow.
I've been there, done that, and some investments were great, some investments not so great. But I always tell people that I have never lost money. I just paid tuitions, and some of those tuitions were greater than others.
I
But
love that outlook. Yeah.
yeah,
It's all a learning lesson. It's like,
it's
well, what
all
is
yeah,
failure? An opportunity to try again and do it better. Every day's a
exactly.
new day.
Exactly. So we,
Wow.
so that's my perspective. But as in the deals that we do, at times we will be asked to be a board member. So I sit on the board of a number of companies in a variety of industries. And as you mentioned, last but not least, Danielle, is I started last year the Private Capital Mastery podcast, which has been a great tool for anyone that's looking to understand how the private capital markets work, how you interact with them, how do where do you start, and how do you get to your intended destination. So I'll kind of stop with the screen share from there, and we can dive in. But
That was awesome.
you know
I felt like I knew you before this, but I didn't know the whole backstory. And story it's so important these days. Again, it's just, your journey, your unique, path that brought you to this point of expertise. And, this morning's LinkedIn post was all about kind of the analogy to a butterfly. Like the process that it goes through, the stages, sometimes they don't seem to make sense. You're like, I'm studying to be a CPA, I'm doing this and that. But all of a sudden you look at that page of all your accolades and you're like, it makes
yeah,
sense. Was it easy? I'm sure it wasn't. I'm sure there was, some tremendous challenges you had to overcome. But now you look, yeah, at sitting on
I don't,
boards and yeah,
yeah,
it's pretty awesome.
yeah, yeah. I mean, I have a total of 4 kids now, and I mean, I don't recommend or advocate being a teenage father, but I had a lot more energy at 16 than I do at 45. But yeah, with that said, in the cocooning process and the process of becoming a butterfly, yeah, it's a really fascinating. When I saw your post, and it made me think of do you remember that movie Cocoon?
No,
It's
I
like an
haven't
old,
seen it. Maybe I got to add it to the list.
maybe I'm messing up the name, but if someone
Yeah.
knows what I'm talking about, feel free to put it
Yeah.
in the chat. But I think that's the name of the movie where the elderly people are renewed. They come up with like a cocoon and they give them renewed life. It's
Oh,
really cool.
wow. That
Yeah, it's a
sounds
cool illustration.
pretty
But
awesome.
shall we dive in?
Let's dive in. I'm so excited.
Okay, let's do it. So we Danielle and I put together some comments and notes that you probably all saw on the invite. And you see my eyes scanning because I'm pulling them up, but
For anyone asking, the movie was Ron. It was a great movie Ron Howard directed, just so we can all Google and watch it.
there we go. Yes, Ron Howard is amazing uh, producer. But what was the name of the movie? Did you find
Douglas,
that?
was it Cocoon?
I think it is. Yeah, I think it was Cocoon.
Yeah. Oh yeah.
Something like
Okay. Yes.
that. Okay. All right, good. Fact checking. Thanks for fact checking me. Um, but I'd like to get, kind of an understanding of, in the group. I mean, and Danielle, maybe you could give me some direction, but how many of those are looking or investing into real estate investments versus business investments? Do we have
Hmm.
an idea or?
Well, everyone's welcome. Already we have Brian. I'm very interested to hear your learnings on the M&A challenges, holdups, personal issues, legal issues. Feel free. We see business investments. Let us know, guys, because this is why we do it live. We're here to really cater to the wants of the audience. So if there's kind of a specific, Brian does it all. He works, as he said, he's doing an event in healthcare. He specializes in real estate. But if there's any particular, feel free to drop that in our chat.
Yeah, and I'm watching the chat now. I wasn't watching it earlier, so.
Yes,
And
yes.
yeah, it looks like Jeannie Cohen loved the movie Cocoon, so I'm probably going to watch that again now that we're all mentioning it.
Yes.
We'll see it trending on Netflix now.
Yeah, oh,
Um,
exactly.
okay, good. Yeah, so I see business investments, and I'll speak to both. But let me just pull my notes up, and we'll dive into that because you know when you think of strategic planning, right? You're trying to you know to get investors into an investment, you also have to show them the way out, right? And
Yeah.
so, and this is kind of the pet peeve that I have, and I always say this, and I need to do it, but a lot of template business plans out there on the internet, there's plenty, but none of them have an exit strategy plan embedded in that business plan. And I think Meritage Partners, we need to create that template and just start circulating it. But compelling the strategic exit plan is key, right? Whether it's business or real estate. And when does that start? Well, that starts the day you start looking at the investment. I'm
Wow.
working on a number of transactions at the moment. One of them is, and I'll start with business. It's an underground infrastructure company. And when you think about, it was explained to me by an industry expert that the underground infrastructure in America, if you could see it, which you can't because it's subterranean, but if you could see it, he says it would in most parts of the country, it's equivalent to horse and buggies on the
Oh,
surface of the
wow.
road
Yeah.
because that's when this infrastructure started being constructed. And there's even stories of how pipes have been fossilized. There's no more pipes; it's just the fossil of the pipe, and gas is running through that and leaching through the soil. It's all that to say there's a lot of tailwinds in underground infrastructure. And so we have this family office that's acquiring the business, majority of the business, and their plans are to double the value over the next 3 to 4 years. So when we went to the market with this business, we not only went to the market telling the story and the history of the business, but we talked about the growth strategy. And there's about 12 different add-on acquisitions that we had targeted and identified because we gave the family office and the investor a pathway to acquiring the platform and then acquiring these add-ons. They don't have to acquire all 12 of them to reach 100 million in revenue, but it certainly, gives them a pathway to
Path.
take this business to do that, right?
Amazing.
And so in addition to that, though, is we did market research and we showed them exactly which companies, later stage private equity groups are investing in this space. And you had big names like Copley Capital. You had Platinum Equity, which is here in LA. Platinum Equity is one of the Gore brothers, if you've heard of the Gore brothers. There's the Gore Group, and then there's Platinum. They do, Platinum Equity they made big moves in going from taking companies public to private, and they did very well with that. But all that to say, going back to this infrastructure company, Platinum Equity is making big investments in infrastructure. And so we were able to show this family office, this investor group, the way into the investment and then the options on the way out. And those options on the way out, we'll put it this way, in our process, we had talked to those bigger players and they were interested in the industry, but they said, look, this opportunity is just too small for us. It's not even a blurb on our radar. Call us back when you get to 10 plus million at EBITDA, and then we'll talk, right? This company's halfway there to as is, where is, and I believe that they can get there relatively quickly. So having that strategic exit plan is key. It's absolutely key. And having that roadmap to increasing the valuation is also key, because those of you that are deploying capital or raising capital to be deployed, you need to show your investors where this return is going to come, right? And as we said earlier in this session, is are you that right group or individual that's going to execute on the strategy? And but having all of this data and market intel, if you would, certainly equips you to have those conversations and to show, having that end in mind, where you intend to be, 3 to 4 to 5 years from now. So I'll kind of pause there for questions or comments, but that's one way that I see is a valuable approach to raising capital, is giving a clear, defined path on how do you get out of the investment and how much money am I making?
I mean, I love that. And I can see where you're working with the family office who is acquiring. So you're showing them the path. Do you also equally work with, say, the founders to help guide them on, this is what the investors are going to look for?
100%. So what we do is we call it exit ready. And we've created this community where it's a one-to-many type setting. And we're giving them actionable advice on, how to build their business to exit it. Because the reality is, as operators, I'm guilty of it as well, but we don't measure our businesses internally the same way an external investor is going to look at our company. They're going to look at different KPIs, number one, right? They're going to be concerned with, revenue concentration, whether that be product, service, geography. They want to understand those relationships, right? And more importantly, when you think of the term exit ready, what we're really saying is, are you transferable?
Right.
You built this beautiful asset, right? But can you transfer it?
There's probably so much that people, like being the operators, don't really think about. You almost are like, here's your cheat sheet. This is all the things you really need to think about.
Exactly. And so, I think of it almost like we typically illustrate a cockpit of an airplane, and you have all these levers and you have all these dials and all these buttons, all designed to keep that plane, steady, right? At the right speed, at the right altitude. And businesses are no different. You need those dashboards, and you have those levers. You just have to know which levers to push and pull, right? And that goes for any industry, and including real estate. I want to touch on real estate for a second, because there are also transactions where, like for example, where we live here in Southern California, a massive landowners is the Irvine Company. And the Irvine Company owns a tremendous amount of real estate, if not most all the real estate out here. But, a company like that has a portfolio of buildings. And, as we went through 2020 and 2021 and 2022, you're seeing a lot of behavioral changes about how we occupy offices. And, we have evolved into this, hybrid work environment. Danielle, I usually talk to you. I'm at my home office.
Yeah.
You're at your home office today, and that wasn't accepted in
Right.
2018. It was
So
like, what are you doing at home?
yeah, exactly.
Was kind of the stigma there, right? But now it's normalized. But going back to this conversation about the Irvine company, I have a client that built a technology. He's an engineer by background, and he electrical engineer. And so what he started to do is he started to say, a lot of these REITs, real estate investment trusts and family offices and landholders, they have to figure out two major things. One, is this going to be a generational play where are they going to pass this real estate down to the next tier of leadership or the next generation of the family? And then two, what are they leaving behind, right? And so if you traditionally had an office building that was built in the 80s, right, that had so many parking stalls and only so much power feeding into the building and only so much water mass feeding into the building, that becomes your restrictions on what you could do with that building from a standpoint of repurposing it.
Right.
And so going back to the client that built this SaaS-based tool, he's an engineer by trade, but he started pulling all of this data from cities and municipalities and power companies, and he was able to determine, based upon the bandwidth of power and water and sewage and parking, and it's AI enabled, so he could give recommendations on, okay, if you repurpose this building to a hybrid office retail setting, right? Here's what your projected rents could be per square foot. Here's the approximate cost that it would take to repurpose that building, right? And then he has again, he's using AI to
Swear AI is amazing.
calculate all of this,
Yeah.
right? And it's a fascinating tool. So I know I'm jumping a bit around, but one segment of our conversation today was going to be, in and around which tools could you be using, for due diligence and best practices, right?
It
But
is.
with technology evolving the way it is, and with a tool like this, I want to back up a little bit, because I think a lot of those that are investing in real estate are going to understand that you could already do this. You could do a environmental impact or survey or study on a building, and you could determine, what is the best use to repurpose that building. However, when you think of the process of acquiring a building as an investor, you have to put your bid in. Your bid has to be won. Once you win your bid, then you go into your due diligence period, right? And then usually in that due diligence period is where you would do the environmental impact studies, or you start to study how else can you use that property. You could have a good idea, but having an AI tool, and I'm trying to remember the name of the platform. I think it's called, it'll come to me in a moment.
I was going to say, if you don't think of it, we'll include it in our follow-up tomorrow, because
Yes.
you talk about collapsing time. When it comes to these deals, timing sometimes can be everything. So to have this assurance that the path, and
Yeah.
I don't want to interrupt the flow of thought, but this you were talking about real estate and thinking long term and the generational transfer. So we had a question. Family offices, I have seen, are very risk adverse with technology investments. I also see a lot of challenges in decision making because of generational challenges. How have you mitigated challenges like this? And I know we're talking about real estate, but we're also talking about AI and technology. And I just thought, you mentioned that whole generational, so the question was really relevant.
Yeah. So I'm I'm in the process of writing a book, and sneak peek. One of those chapters in that book is titled "You Cannot Sell a Problem," right? And that's what this question is about. This question is about, how do you get others to subscribe to a concept or a strategy that you yourself haven't even figured out? So,
Mhm.
to really, when you think of risk averse investors and family offices, you can't you can't sell a problem. And if you do, you're selling it at a discount because it's a problem. Someone else has to solve it for you. So really, it's in my mind, and the things that we do is we will help, employ these types of tools, because the punchline there with this tool is you don't have to wait till you win the bid and you're in due diligence. You could do it automatically to as many properties as you want across the country and have it spit out the results within a couple hours. And it
Helps you
does take
make
a
your
couple
investment
hours.
decisions. Yeah, it's incredible.
Precisely. It becomes your compass on, okay, where should you be investing and why, right? So so to when you think of risk averse investors, and as they should be, right? I always remind people that family offices and private equity groups and investors, they're not trying to squeeze you. They're not trying to, they're not trying to get you to step on a landmine where they say, "Oh, I got you," right? I mean, ultimately, they have a fiduciary responsibility to the capital that they're deploying into investment. So they should be asking the hard questions. They should be risk adverse, right? But when you can't you can't sell a problem, I said, but you can't ignore these things. And so you really have to address them by having the knowledge. And how do you obtain that knowledge? Well, are you the right person to execute on the strategy that you're raising money for, right?
Mhm.
And maybe you've done this somewhere else in the country or in the world, and you're taking those same SOPs and that same process and that same approach and applying it, to now this, let's say, new investment that you're looking to raise capital for. But when it comes to, so I think there's two parts of that question. It was also challenges related to generational challenges, right? Um, Specifically, what was that question related to? Is it more so like passing on the investment, or is it more family offices investing with the second generation?
I can definitely reread it, but Subs, who asked the question, has already come back and said, "That's the best answer I've ever heard, Brian. You cannot sell a problem." True that. That explains the risk adverse nature. So it's, you know, I think reassurance, guidance, trust, tools, data all help, but
They
yeah.
do, they do,
Um,
and they, yeah.
Now, there are other questions, Sub, feel free if there's any add-on to your initial question that you'd like, Brian. Nope, you got it. So if you're
Yeah, good.
okay, we'll read. Corey's got a question for you. So in your opinion, what kind of asset class or niche opportunities interest you? Like you said, more institutional players sometimes neglect unproven geographies or businesses that are primed for upside growth. In other words, what unique opportunities have compelled you?
So, we're no different than stockbrokers, right? But we're just trading stock of privately held companies. And so if you're a stockbroker trading on the public markets, you have to stay with trends. You have to know what's trending and what's not. In 2009 to 2013, architects and engineers were struggling. Healthcare was booming, right? Uh, from about 2005 to 2013, we transacted almost $350 million clinical labs, pathology labs, anatomic labs. Now, when you go to our website, you'll see most of these went to LabCorp, the number two largest public company in the marketplace. But there's always trends, right? And so right now, what are those trends? There's a lot. Obviously, software is exciting because you have monthly recurring revenue and you have annual recurring revenue. It's predictable. It's sticky. Investors like that, right? Because this is not project work. You're not selling time and materials. So, but when you think of that, when you think about the reoccurring revenue model, historically we just think, yeah, the software companies. But no, that's not the only industry. There's a group called Leonard Green. It's an equity group out of Los Angeles. And when we studied the common denominator of all the investments they made, and I'll tell you that they were Equinox Gym, LA Fitness. I'm going off memory, but Mr. Car Wash. Um, those are the ones I can remember right now. But the common denominator of these investments is they all have a monthly reoccurring membership, right? So gym memberships to car wash members, unlimited car washes. Bring your car, we'll wash it a million times, right? But that was the common theme, and they did very well. When you look at their white papers, um, they did extremely well with car washes. And historically, in the '80s, nobody in the investment community, at least institutional investors, were investing in car washes because it was cash. No one knew where the money was going, right? Good for the owners in the '80s of those businesses because nobody knew where that money was going. All right. So, but and then you kind of now you look at that theme and that concept of recurring revenue. Well, who else has recurring revenue? And so this is why now home services is explosive. HVAC is explosive. Commercial landscaping is explosive. Um, we're even now seeing there's an equity group out of Florida that's now buying pool service companies because there again, if you own
Yes.
a swimming pool,
Yes.
you're
Just
no
more and
matter what
more.
the economy is doing, you got to clean that pool.
Yeah, you think about all of the applications of a revenue model. So, and not to interrupt you, but could we get the name of that
Please,
equity group again?
Leonard Green,
Leonard Green. Got
Leonard
it.
Green out of
Awesome.
Los Angeles. I can't think. I think it's Triveth out of Florida that's doing rolling up pool service providers, but it's two parts, right? So you have the monthly recurring revenue component, but then you have all of these, project-based work where equipment breaks, it's got to be replaced, and they're the first people on the scene to tell you it's broken, right? But you saw this with HVAC. I had a guest, Adam Coffey's become a friend of mine. He wrote the book, The Private Equity Playbook, and he
Mm,
also wrote a book called The Exit Strategy Playbook. And Adam Coffey, he was the CEO of CoolSys, based in Brea, California. CoolSys, I think, is approaching $1 billion of revenue, annual revenue, but they maintain climate controlled environments for food, for people, buildings. I mean, think of anywhere there's climate control. But if you own a grocery store, if you're fill in the blank of the name of the grocery store, that you like, Trader Joe's, like
yeah.
if these HVAC systems, refrigeration systems go down, you're talking about massive claims on product. And so there's monthly reoccurring maintenance that's involved in climate controlling HVAC. And so this is why companies like this have been trending because of that reoccurring predictable revenue stream.
Awesome.
I'll pause
Awesome.
there. Yeah.
So we've got a lot of questions. I hope you're okay with this. We're not like railroading, but I guess this is for you. So,
Yeah,
Douglas
fire away.
asks, what type of returns and exits are family offices looking for when it comes to real estate? How do hotels compare to multifamily or condo for expected returns and exit?
Okay, so this is a good one, and this hospitality has been evolving. Um, there's a group out here called Architects Orange in California, and they have really changed the landscape of California, Southern California, because they're doing what they call these wraparound buildings. Okay, and so what? Let me tell you why they call them wraparound buildings. They do the multi-level parking structure in the center, which is concrete, and then they build stick condos. Sticks meaning wood. That means wood
Yeah.
around the structure, and they're able to go more than 4 stories. I think they go up to 6 stories now, but they could do this with sticks, which is a lower cost of construction. But they could do it because they're bolting on basically to a concrete structure, which is a parking structure that sits in the middle, and then they typically have rooftop pools and entertainment, right?
Wow.
Even outdoor gyms. They're beautiful. But there's more to that story because when you think of a company, it's no different than a piece of real estate. Investors want reoccurring predictable revenue. They want diversified revenue, right? And so when you think of a building, you think, okay, well, how do we diversify the revenue stream? And so a lot of these wraparound buildings, they're doing retail on the first level. And the beauty is you have built-in customers that live right above it.
And you have your
Right.
parking right in the center.
And you
That's
have your
amazing.
parking right in the center. And so you have, there's ancillary services and offerings that are provided to the tenants of these buildings, facilities. But the reality is they're able to derive different revenue streams from, a retail tenant, a residential tenant, as an example, where before, if you were an apartment building, that's all you were, right? So now, it's predictable revenue, yes, but it's coming from both retail and residential. Some of them, if the zoning allows, they'll do commercial in addition to that. But it just really depends on the zoning.
Brilliant model. Get a subscription to the gym on the roof, and you got everything.
Yeah, I mean, I remember seeing a deck for Simon Malls. You know Simon Malls. They're one of the nation's, if not the nation's largest holder of malls throughout the country. But they have a lot of plans where they're doing, they're generating revenue from freeway signage that they just never thought about it before, right? They're generating revenue they have events, but I've seen some of the architectural plans where you have a mall that's 1 or 2 stories historically,
Right.
and they're coring out the center of it, and they're going 12 stories up with condos.
Oh,
And there
wow.
again, you have a built-in customer base right above your retail shopping center.
I
So
love
I
it.
mean, but it
All,
is,
all,
yeah. I mean,
yeah.
exactly.
Wow.
Yeah.
All right. Well, there's questions piling up. Now, this one is still kind of along the lines because we're talking about garage spaces. So I'm going to read it and then I'll backtrack to one earlier. But based on the Leonard Green story, I wonder why they haven't moved into garage spaces parking, although I'm aware of the standard parkings company, et cetera, own a massive amount of it. Any thoughts or comments on that?
I don't know. I don't know if they're invested or not invested, because sometimes, if they co-invest, I mean, there's usually a lead. I mean, it depends if they're the lead equity investor, we're going to know. If they are an LP, under some other holding company, we just may not know. But I agree, parking is massive, right? And I do a lot of work in the architectural and engineering space, and I was having a conversation with an architect that designs nothing but parking structures. And so it was a university. Actually, I was going to say it's a local university, but this is relevant to all the parking projects they're doing across the country. And the question is, will we need as much parking in 20 years as we do today? And the answer is no. Over time, it's projected that less and less of us will be driving. There'll be autonomous vehicles, there'll be services like Uber and Lyft. We just won't be driving. And you even look at the younger generation, even my kids, like, you got to push them to drive. They didn't really, I
Yeah.
mean, 15 and a half, I was getting my permit. On my birthday, I was getting my license at 16, right? That's just the way we used to do it, right?
Yeah.
But going back to parking, is the projection for parking is it's going to decline over time. So they're architecting these parking structures to be repurposed to residential,
Yeah.
retail, or commercial.
Amazing.
So in short, when you think of a parking structure, they're usually sloped and you could go multi-level. But now what they're doing is they're making these parking levels structures flat, and they're
Wow.
doing roundabouts on the perimeter of the parking structure. So if they ever wanted to repurpose the structure
Yeah.
to, let's say, condos, they can. They just rip out the exterior roundabout.
I love it.
and
It's
it,
that
yeah,
forward thinking, long-term strategy.
yeah, exactly. So it's hopefully that gives some direction, some answers on parking.
Yes, definitely. There was a little joke cracked here. I'll read for you. Maybe one day Leonard Greens will invest in parking spaces when the UFOs start landing. Uh, so we're gonna
Well, I'll
switch
tell you,
it.
yeah.
No, sorry, go ahead.
No, no, I'm just behind me. It's hard to see, but no, you can't see it. I'm moving the wrong camera, but there's a
Oh,
parking spot out there for boats, not UFOs, but for boats.
amazing.
And there's this massive boat that comes in here for 2 weeks a year. It's a builder, and it's his mooring fee, his buoy fee is $20,000 a day because they have to shut down and have surveillance, and it's
Amazing.
crazy. But
That is
but
crazy.
yeah, if they handle UFOs the same way, it's not gonna be cheap.
Yeah, there you go. All right, so we're shifting gears a bit. Keys asks, the leisure and themed entertainment market seems underestimated with VC and family offices. Is that also your experience? Would love to get your thoughts.
Hmm.
Leisure and themed entertainment.
Okay. So yeah, this is an interesting because the I'm gonna separate the two,
Mhm.
leisure and entertainment, because entertainment is more, it requires an artistic ability, and that really depends on the individual or the individuals. Think of Disney, think of Universal, think of, um, those markets, right? When I think of leisure, I kind of mix that with hospitality. Maybe that's what they're referring to, but is it underestimated? I think so. And I'll kind of, this is why I say I think so. We were looking at an opportunity, uh, AI driven opportunity. And I'm really obviously terrible at actors and movie names. And obviously, I couldn't remember Cocoon if that was the actual name of the movie. But this group has has trained AI to read transcripts of movies and TV shows and storylines for video games. And what the AI can do, um, it'll simulate spin-off TV shows or movies. And again, I'm really bad at this because I don't watch TV, but
Okay.
there was a show called Breaking Bad. And I know the show because it had a spin-off show called Call Sal, or you guys can help me. I'm
Yeah,
just terrible at this. But
yeah,
anyway, so that was a spin-off of one character in Breaking Bad, and it was a success. And so these guys said to themselves, well, how do we do more and more of this? Because the reality is, I mean, we're going to have Back to the Future #4 coming out. And it's like all
yeah,
of our childhood movies that we
yeah.
watched, it feels like all the creativity also stopped in the 90s. Like there's the new movies that are out are just regurgitated versions of what we saw as kids, right?
Right.
And so these this group is in the entertainment business. Partners have some partners in the technology business, and they're now simulating what are likely shows or movies that could derive from a video game, an old movie, a new movie, or a TV
Mhm.
show. And so they're scanning transcripts of these movies. They're trying to figure out,
Unbelievable.
I don't know how they triangulate this data, but they
How do
figure
you
out,
train that model? Yeah,
yeah, but what characters do people like? What
yeah.
characters do people want to know more about? So I do think it's underestimated from that standpoint. And I think we talked about earlier, having tools for due diligence, and whether it be business or real estate, you could apply this to entertainment. Because if you could sit with a table full of investors and you're pitching a movie, and that movie is based upon a character that was in a movie 20 years ago that people still talk about and love, you can simulate the likelihood of success of that movie. Therefore, you are more likely to engage investors to participate in the investment opportunity to fund that movie. And that's what we see with this technology that I was describing. So I
Amazing.
do think it's underestimated, but with these tools, it's going to equip us to do more in less time. That's collapse time.
Wow. Anything specific to location-based entertainment and amusement parks? Any thoughts there?
Yeah, I think I don't have much experience there, but other than personally participating, right?
Right.
Um, that picture I flashed earlier, my family was on a Disney cruise last year, and we're doing back-to-back Disney cruises in a couple weeks out of Florida. And I can tell you, Disney is an example. They've had, theme parks and they backfilled every ride that they had, never had a movie. Now every ride has a
Yeah,
movie, right?
I'm true.
And
Yeah.
so, and now they've taken this concept to cruise lines and hotels. And so not too different than what I was just describing with about movies, yeah, I think entertainment's taking its new shape and form. Um, and you have seasons and like even Universal Studios in Hollywood, they do this massive production for Halloween. And it's called the Halloween Horror Nights or something scary.
Yeah.
I still can't watch scary movies to this day. So, but all that to say, I think they're charging up to $500 for a VIP experience, and it's
Wow.
it's it's creative because they call it RIP versus
Yeah.
VIP, and so it kind of goes with the trend.
Yeah.
But yeah, I think in amusement park theme locations, they are also looking at different revenue streams versus the traditional. Here's my here's my money for a ticket. Now let me in, right?
Right.
You're seeing,
Like
so you're
premium options. Yeah.
yeah, premium options. I mean, there's this whole YouTube video about how lines at Disneyland have been engineered to take longer. And they've engineered them to take longer, so it compels you as the consumer to buy a fast pass or whatever they call it, genie pass, whatever they call it,
Right. Here's your solution.
to the point where I don't even want to go unless we have that, right?
Right. Right.
Because you're either going to spend time. I mean, you see the families. I mean, they're spending 12 hours there. They look like they went to the depths of hell and back by the end of the day. They're tired. They're hungry. The kids are a mess. But if you pay a fee, you could get in front of the line and you could do Disneyland in 6 hours versus 12.
See, now with that trick, maybe I could convince my husband to go because he's like, no, no, he's not a line guy,
I'm
but hey.
I'm with your husband. I refuse. Like honestly, it's time. Like you don't want to
Yes.
sit in a line,
Yes.
but
Everything's
yeah,
a choice. This is
yes.
just kind of a personal one for you, Brian. Sumit asked, how many private businesses have you completed M&A transactions? Can you count them
Mm.
all? Hmm.
So we're very careful. We close on 85% of the clients that we bring on, and we do that not because we have some sort of wizardry or magic spell on people. We're very selective on what we bring on. And so we have seen thousands upon thousands. We probably see every year, gosh, I'm trying to put between 1,000 to 1,200 opportunities a year. It's a lot. We will represent somewhere between 15 to 21 companies a year, right? And I don't know if I'm exactly answering the question, but if I do the math, we've transacted not in the thousands, but in the hundreds. I would say mid 100s, like 500, 400 to 500 deals, M&A transactions or growth capital transactions. So, our clients typically have, from an EBITDA standpoint, from $3 to $20 million of EBITDA and everything in between, to kind of put it in perspective.
Yeah. Well, I know we are, drawing close to the top of the hour.
Yes.
But I want to make, if anyone has a last minute question, otherwise we can let Brian kind of conclude with any parting wisdom ways that we can get in touch with him. Like I said, I'll make sure to include all of his information in tomorrow's follow up with the recording. Yes, lots of people thanking you. Incredible session. And yeah, I'm just very appreciative. Everyone thinks this could be a 2-hour session. Maybe we need to have a part two. I would love
Let's
it.
I love it too. Yeah,
To be
let's plan
continued.
for it.
Yes,
Yeah.
exactly.
Yeah. So I appreciate the time here with everybody. Hopefully it was thought provoking and I, you know, shared something that made you think differently or, make you see the world differently, but, happy to be a resource for you. Our firm is, we are based in Newport Beach, but we do cross-border deals in Canada. So we service North America. I'm always looking for deals in Hawaii or any tropical destination.
Yes.
Which I actually I've done a couple deals in Hawaii. One was a energy. It was a commercial oil lubricants, and they had an exclusive with Chevron, and that's a fun story. The short story is we thought we had the market cornered, and we know we had all these options of where that business could go in terms of investors. We found out that there was really only one investor. The Hawaiian Islands are very,
Yeah.
it's there's a bit of a monopoly down there. Let's put it that
Yeah.
way.
Oh,
Yeah.
well, I think we have time. This is a really good one. I want to hear selfishly the answer as well.
Yeah.
They say we definitely need a part 2 and 3.
Let's
But
do it.
yes, what's the future of the family offices as generations change? Get out your crystal.
So yeah, I mean, you and I talked about this before. You're seeing, younger generations coming into the family office with different purpose. So purpose is certainly changing. What was compelling prior generations to invest in industrials or manufacturing, the newer generation are saying, well, no, we want to make impact on the world, or, we see a vision in software technology. So purpose is certainly shifting the landscape of family offices. But also there's in private equity, there's going to be a shift over the next 10 years where you have all these segmented private equity groups, and all these private equity groups are acquiring segmented companies in a variety of industries. Well, we're at a place in a stage where we're going to see private equity groups who are segmented coming together. And when we see that, the larger equity groups are going to get larger, and medium, small, and so on. Everyone's going to rise with the tide. So here's what I think. I think that that's going to leave a space. We call it no man's land, right? So investments in companies where they're just too big for the local bank, national or retail bank, but too small for private equity, because private equity is going to start looking at larger and larger deals over time. So there's going to be this space I call no man's land where family offices are going to play a massive role there. And I think that's going to be an opportunity that's going to span, I think, 2 decades, because you have generations moving, you have wealth transferring. We're in the middle of the biggest wealth transfer in human history, right? As an example. So I think family offices are going to play a bigger role. And I think they're going to come together as LPs or limited partners and really replicate what the smaller equity groups were doing.
Mhm.
But I think that's going to change. So that's my input. That's my feedback.
Amazing. Well, great answer. Yeah, part 2, 3, 4, and 5. So this will definitely be continued. I see it's 2. I want to be mindful of everyone's time. Brian, I can't thank you enough. It was awesome. I learned a tremendous amount, not just about you personally, what you do at Meritage, professionally, but just the market and real estate and business acquisitions, the importance of having that strategy for exit. It's everyone should think about it, and that's what we're working towards at the end of the day. So thank you for imparting your wisdom. Really quick, top of my list, we've got Jay Bartlett. You are our gift suite winner. I will follow up to get your address. Brian, I'll work to get you your gift as well. Yeah, we'll send out an email tomorrow. And yeah, Brian, I'm sure your LinkedIn is going to be exploding. There were a few more questions we didn't get to, but feel free to reach out to Brian on LinkedIn, and we'll look forward to bringing you more in the future. Thanks, everyone.
Thank you, Danielle. I'll see you soon. Thanks, everyone.
Bye.
Bye-bye.